Good evening, everyone. Time for another silver update. This is the weekly chart of silver provided by netdania.com. You can click on the link below. Now, silver is starting to look like it may actually want to do one more test of these lows. And this is going to be very interesting because the real support, if we get through those highs made in 2008, is actually down around 15. So there's a possibility that we may get an incredible buying opportunity. And of course, critics are going to say, well, you said that all along, and I guess it's going to zero. But again, the machinations continue. There's all kinds of news I can't even cover. Stuff with JP Morgan and Blythe Masters and stuff like that. But it does appear just from the chart reading that they may be trying to take it low below these prices, especially here around 18, and that certainly would be capitulation. There's no question about that. Now, the gold chart is not quite as ugly. You can see that, and we know that the Baltic Dry is plumbing new depths, so the disconnect between silver and gold seems to be continuing. I wanted to take you over to a chart of the Chinese currency, the yuan or the renminbi, and put this out on the daily to show you what's going on. Now, if you remember, I had predicted and been wrong so far that this is going to be a short-term bounce and it was going to turn around. You can see the long-term trend. It's not the longest-term trend, but a fairly long-term trend from back in 2010 was significantly broken here, and it appears to be kind of forming up a pennant here. Now, what's interesting about this is this coincides with the announcement by China that they're widening the bands. So we're going to read a little bit about this and then read a little bit about Janet Yellen and what's going on here. Now, I've reported for many, many years that there's simply no end to the, I call it China bashing, but it's disinformation about China, and the mainstream media just can't help it. They always do this. This story has literally been running. No exaggeration. I've seen this same story for the last 10 years straight, and they're always talking about slowdown in China, and it never happens. Now let's look at the latest here. And I'm not going to debate whether these are accurate numbers. I personally believe, I don't think you can know for sure, but I personally believe that the Chinese numbers are actually more accurate than our numbers. A lot of that's anecdotal. Just look at the wealth and growth in the cities in China and the decay and just despair in the United States. But also I believe that probably their government's actually more honest than ours. But let's look at these numbers. China's economy grew by 7.4% in the first quarter of 2014, the slowest rate since September 2012. Woo! And below the 7.5% target. So it's below that 7.5% target, and so they missed it by 0.1%. So that's a big tragedy there, and of course that's just laughable. Anybody in the US or the EU or any of the Western economies would absolutely kill for a 7.4% growth rate. And then there's the comments from Lauren Lister, she's just a media gal, doesn't know anything. But here's the retail sales. Retail sales in China were up 12.2% year over year. Can you imagine that? The sales rose 12.2% over the previous year. And this has happened year after year after year. But industrial production missed estimates at 8.8%. So this was a miss. Can you imagine if we had numbers like that? Quote, clearly they have a slowdown going on, says the Daily Ticker's Aaron Task, and they're trying to manage it. One of the ways China is attempting to manage is by intervening in the currency markets to weaken the yuan after years of increasing in value. A semi-annual U.S. Treasury report released to Congress Tuesday said the Chinese currency remains significantly undervalued and could appreciate it if it were able to trade more freely. The U.S. has been encouraging China to stop intervening with the currency and let the markets set the value. Now, that's very interesting because when we look at this chart, we know that this occurrence here, right in here, this actually occurred when they widened the bands. So there's been a lot of speculation as to what would happen if China let their currency float, and there's a worry. This is the US dollar CNY. So as this goes down, that's the US dollar weakening against the Chinese currency. This recent spike here, this is the Chinese currency weakening against the dollar. So that belies their statement. Now, perhaps they're saying the Chinese are intervening in some other way to cause their currency to weaken, but they're certainly not causing it to weaken by having those tight, what they had traditionally had. You can see it if we go out to the weekly. China had bands that they allowed their currency to trade in, which caused this slow decline because it could only move by a certain amount. And of course, this is the slow decline of the dollar that the Chinese currency wanted to strengthen, because obviously the Chinese economy is continuing to grow, getting stronger and stronger and stronger. The U.S. economy is continuing to sputter. Deficits and debts are growing larger and larger and larger. So we would expect that naturally the Chinese currency would strengthen against the dollar, which is exactly what this trend is. They just didn't want it to strengthen too fast. Now what's interesting is now they loosen up the bands, it goes the other way. So none of that makes any sense, and of course for the US to accuse China of being currency manipulators is beyond the pot calling the kettle black. The United States is the biggest manipulator of everything, including currencies, interest rates, stock markets, etc. So now here's a Fed president admitting that the policies have made the rich much richer. Despite Janet Yellen's meet and greet with the unemployed and criminal classes, the absence of Ben Bernanke has seemingly empowered several Fed heads to be just a little too frank or honest about their views. The uncomfortable truth sayer this time is none other than Dallas Fed's Fisher. Fisher says Fed policies have made the rich much richer, but Fisher is unclear if Fed policies will benefit the middle class. So what the Fed is, and here's a chart here of you can see the poorest Americans, 23.3 million, control 47 billion, and that's the income, and it's 64.3 for about 3,000 of the richest Americans. So of course that's a direct result of the Federal Reserve's policies. So let's look at the latest from Yellen. Now, I've talked about the fact before that Janet Yellen had to be reined in because if you remember the first time she came out there and opened her mouth, the markets tanked on that because she was talking about tapering and interest rates normalizing and all kinds of stuff like that. Then all of a sudden they had another Fed head out there and she kind of got in trouble for what she said, and now she's come out and now she's towing the line. So here's the story. The length of time the Federal Reserve keeps its key interest rate near zero will depend on how far the U.S. economy remains from the central bank's employment and inflation goals and how long it will likely take to meet them, Fed Chair Janet Yellen said on Wednesday. Yellen, in her public speech as Fed Chair, largely restated the central bank's stance, stressed that it would respond to shifting economic conditions as it judges when to finally tighten monetary policy. The stock market held on to most of the session's gains following Yellen's dovish remarks, with the Nasdaq flirting with a 1% rise. Treasuries tick slightly lower, the 5-year Treasury, etc. The central bank frustrated with slow U.S. recovery from recession. Now think about this. They're talking about China fudging numbers and things like this. They're talking about a recovery from a recession. We know that the recession was announced in December of 2007 and was declared to have ended in June of 2009. I believe those are the correct numbers. So we're talking about it started almost 7 years ago and it was over almost 5 years ago. So that's the insanity, or I guess we should say, yeah, almost 5 years ago. It was over. So why are they even talking about a recovery? Well, that's because there isn't a recovery. Aims for maximum sustainable employment and a rise in inflation from just above 1% to now to 2%. What is maximum sustainable employment? What kind of an insane term is that? Is there maximum employment that's not sustainable? And how can we have maximum sustainable employment when the workforce participation rate continues to fall? What on earth are these people talking about? I hope it's completely clear that while monetary policy is very accommodating at this point, and I focused on the need to keep it so or to adjust it to make sure the recovery remains on track, Yellen said during a question and answer session at the Economic Club in New York. As the recovery proceeds and healing occurs, it's obvious that we will need to tighten monetary policy to avoid overshooting our target. What target is she talking about overshooting? Is she saying that inflation will overshoot? Well, that can't overshoot because they defined it out of existence. Is she talking about employment will overshoot? Well, we know that the unemployment rate keeps dropping. That's because they cook the books and don't count the people who've fallen off. So they're cooking the employment number, they're cooking the inflation number, so how can the numbers possibly overshoot? She added that the Fed remains focused on removing accommodation when the time is right. Now there's some guidance. See, you can see that Yellen is getting a little bit better at her Mr. Mumble's Greenspan or her Bernanke doublespeak. She's getting better at being vague, and that the central bank has learned that overshooting its target can be very costly to reverse. The larger the shortfall of employment or inflation from their respective objectives and the slower the projected progress toward those objectives, the longer the current target range for the federal funds rate is likely to be maintained. This approach underscores the continuing commitment of the Fed's policy setting committee, FOMC, to maintain the appropriate degree of accommodation to support the recovery. Now we're talking about 0% interest rates. That's what we're talking about, 0% interest rates. And we're talking about a stock market that continues to be pumped up to the moon, and they don't want to let it come down in any way. You can see right now they're trying to form up, if we pull out to the daily, it gives you a better view. We're trying to form up another one of these breakout formations here, and we've had some correction, but they desperately do not want the stock market to go down. So while we're accusing China of being market manipulators, China is actually less of a manipulator than we are. Their numbers are fantastic, the numbers that they're reporting, and they are actually turning around and loosening the bands on their currency. We are accusing them of manipulating the currency as they do exactly what we've requested them to do, but what's happening is that their currency is weakening anyway. So none of it makes any sense. It's all just a bunch of smoke and mirrors, but it's interesting that Janet Yellen has learned her lesson that she needs to basically speak in riddles and say a bunch of gobbledygook and then go and goose the markets. Now, the other story that has been covered recently by a lot of places, Zero Hedge included, is this story of Belgium And if you're familiar with Belgium, let's go ahead and put this in here. The story of Belgium increasing their treasury holdings up to 300 plus billion dollars in a very, very short time. And you can see here that we're talking about a country that has a population of 11 million people, okay? And we're talking about a GDP of 420 billion. That's per capita GDP of 37,000 per person. So how in the world is it possible that just in a very short time that Belgium has increased their ownership of treasuries? Well, we know what's going on. We know that it is the Federal Reserve that is behind, always has been behind the Caribbean banks that were buying our treasuries. Now they're using Belgium, they've used England, they've used the EU, they've used all these countries because the Federal Reserve doesn't want to admit that all they can do right now is just continue to print money. And if Janet Yellen even hints at not printing money and even thinks about raising rates, then obviously she's going to be taken to the woodshed again, which is what's been happening recently. And that gives an opportunity to goose the stock market and to suppress the precious metals. So same thing continues. We're just waiting for a big change in that. I have the feeling that it's coming soon, but no one knows. We may be getting a very good dip buying opportunity out of silver as we may test that 18 low. And we'll talk to you next time.